All right, we're moving on to Chapter 8, and Chapter 8 is about long-lived assets. Plant assets, property, plant, and equipment. They have physical substance, a building, a desk, a car, a computer. They're used in the operations of a business. They're not intended for sale to customers. They're expected to provide service to the company for a number of years. Except for land, are expected to decline in service potential over their useful lives. So again, we have to recognize that uh, decline in value by depreciation. If you think about a company, next time you go somewhere, just look at the types of assets they have. We've talked about Chick-fil-A. Chick-fil-A has land, of course. They have a building. They have drive-through windows. They have tables, chairs, cooking equipment, computers, communication systems, storage, etc. So these are all assets that they use in their business to produce revenue. And these are referred to property, plant, and equipment. There are some, you can have Wendy's, which of course is a competitor of Chick-fil-A, and they have a large percentage of their assets are in plant assets because that's what they do. They have to have physical locations, hospitals, healthcare companies, airlines. Airlines have to have airplanes. Target, Tesla has to have a manufacturing facility. Caterpillar would think that theirs should be a little more, but Microsoft, they're more into software, and so the assets they would have probably would be server farms, things like that. So we determine the cost of an asset based on its historical principle, and it's all expenditures necessary to acquire an asset and make it ready for its intended use. And actually, that should also say at its intended location. Revenue expenditures are costs incurred but expense immediately rather than included in a planned asset account. And so these would be things that have a life less than 12 months. Salaries would be something. Insurance, of course, insurance, if you have prepaid insurance, you would expense a monthly amount each month. Capital expenditures would be costs included in plant asset account. Cost, again, is the fair value of asset given up or fair value of an asset received. So if you were to trade land for something else, you would look at the fair market value of the land or the fair market value of whatever you're trading to determine what the true cost is. So once its cost is established, becomes the basis of an accounting. In an earlier slide, we looked at the cost of an asset. So it is the cost, it's the sales taxes, any commissions needed, installation costs, transportation costs, because again, it's everything necessary to get it to its intended use at its intended location. Land, purchase price, attorney fees, title search, real estate brokerage commissions. If you have to pay property taxes that are due, that's part of the purchase as well. So here we've got cash cost of 100,000, property came to an old warehouse that is removed at a cost of 6,000. So we're buying land. The building is actually a hindrance. So we want to get the land ready for its intended use at its intended location. Well, obviously it's at its intended location, but we're going to build a building there. So if there is a building already and we don't need it, then that's part of the land costs. Then we have attorney's fees of 1,000 and broker's commissions. And so you add all those together, and that's going to be the cost of the land. Land improvements are items that you put on the land, but are going to deteriorate over the long term. So driveways will last a while, but they eventually will deteriorate. Parking lots, fences, underground sprinklers, they have limited useful lives. So You determine what that life is, and then you depreciate it over that life. Buildings would be, the purchase price, closing cost, any remodeling, all the construction. If you lease a building and you then do, and let's say you lease it for 5 years, but it's not ready for you, so you have to go in and do construction, change offices, add things, etc. All of those costs would be an asset, leasehold improvements, and then you would take those leasehold improvements and depreciate them over the term of the lease. Equipment, again, cash price, sales taxes, freight charges, insurance during transit paid by purchaser, expenditures for assembling, installing, and testing. Now, once that asset is ready, any uh, problems after that that aren't covered by the warranty are then an expense, maintenance. So here we have the delivery truck. Again, you want to put your label on the delivery truck, so that would be part of the cost because it's not ready until you put your logo on it. So if it costs you 25,000 in cash plus prepaid insurance, equipment is going to be 23,800. Your expense is just the $80 for the motor vehicle license because that's something that you have to buy every year. So that's not part of the actual asset. So you can see here cash price of 50,000, sales tax, insurance during shipping, and installation and testing. So it's going to go in your books at 54,500. So you're going to debit equipment and you're going to credit cash, or you might credit accounts payable, accounts or notes payable, etc. Again, ordinary repairs are expenditures to maintain the operating efficiency and expected productive life of the unit. So anything you do to keep it in the state that it's supposed to be in, those are expenses. Anything that improves the asset, extends the life, makes it more useful, those would be additions and improvements, and those would be capitalized. Here, assume that Drummond Corporation purchased a delivery truck for $15,000. They pay sales tax of $900, delivery cost of $500. The buyer pays $200 for painting and lettering, $600 for an annual insurance policy, and $80 for the motor vehicle, which we just saw. So the $600 for the annual insurance policy, that is going to be an expense. $80 for the vehicle license is an expense as well. So depreciation. How do we depreciate things? It's the process of cost allocation, not asset valuation. Applies to land improvements, building, and equipment, not land. Land is never depreciated, so land never theoretically goes down in value. You probably heard of Chernobyl, which is in the Ukraine when it was still part of the Soviet Union, and they had a nuclear accident, but I don't think that land is still usable, so that is one of the situations where the land value does decline. Depreciable asset because the revenue producing ability of an asset will decline over the asset's useful life. Now, we've been in a weird period here the last few years. Typically, I will look at what the value of my cars are at the end of the year, and usually they have declined in value. I think that's the situation now, but there was a period where the value of a used car actually went up. But typically, that's not the case. So, normally, if you buy a car at the end of the year, it's going to be worth less than what you paid. And that difference is depreciation. Although that's not how depreciation is figured. Normally, it is done on a systematic basis. So, you have, in this case, you see that they have a truck and they believe the truck is going to be useful for 6 years. So, they're really going to allocate the decline in value over those 6 years. And there's a couple of different methods that you can use, which we'll talk about. You can see here that the cost, all expenditures necessary to acquire the asset, make it ready for its intended use at its intended location. You have the useful life, estimate of the expected life based on the need for repair, service life, and vulnerability to obsolescence. And then we have the salvage value. So when we get rid of this, what is the value? What do we expect the value to be? Now, these are all estimates, and there are no hard and fast things. I was responsible for accounts receipt or fixed assets for the company I worked for, and we had a salvage value of zero. We would depreciate computers over 3 years, so after 3 years, they would have a book value of zero. So if we made a little money on it, that would be a gain on disposal. We'll talk about that later. So similar to bad debt, again, you have a bad debt expense, but then the credit side goes to a contra asset account, and that's what happens with depreciation. You have a depreciation expense, and then the credit side goes to an accumulated depreciation account, so that at any point you will know what the net book value is, which is the asset value plus the accumulated depreciation. And since accumulated depreciation is a contra account, it has the opposite sign. So you add them together and you reduce the net. We have three methods: straight line, declining balance, units of activity. Declining balance, we're not really going to focus on. It's an accelerated form of depreciation, and that's what you need to know. And accelerated means that you depreciate it higher in the first year than you do the last year. And again, that goes back to that you want to lower your income in early years to lower your taxes and increase your cash flow. But we're talking about GAAP. Now, most companies do have accelerated depreciation for tax purposes, and the tax is really, it's called the MACRS, the Modified Asset Recovery System, basically. So they pretty much tell you how you're going to depreciate things, and it is accelerated, so there's more depreciation early than late. So the declining balance method, you just need to know, is an accelerated, but from a GAAP standpoint, you don't, again, you want to make your numbers look better, so you will not probably use the accelerated depreciation. Although in some cases, you might. If you're a cab company, you might want to depreciate cars. Well, that's probably using the units of activity method. So when we're talking about depreciation, there are certain things you need to take into account. And so one is the cost, and then the expected salvage value, the useful life, and it can either be in, okay, so the useful life is going to be the factor. And so you're going to divide the depreciable basis by that factor. In this case, our cost is $13,000. Our expected salvage value is $1,000, or also called the residual value. So our depreciable basis is the difference between those two, which is $12,000. Now, as I said, company I worked for, we had a salvage value of zero. So we would basically be depreciating the whole amount. So all of the cost really was the depreciable basis. So you're either going to do it by years or by useful life, which is the units of activity. All right, so that's the factor. You're either going to do it by time. So in the case of time, you're going to depreciate $12,000 over 5 years, which would be, let's see, 5, that's 1. Anyway, I'll show you here in a minute. Or you're going to do it by the useful life. So if we're using the straight line method, we're going to divide it by time. Straight line uses time. So we're going to depreciate it over 60 months, which is, again, 5 years times 60 months. So that's $200 a month. All right. So every month we're going to have an expense of depreciation of $200 and accumulated depreciation of $200. So after 5 years, we'll have a cost of $13,000, and we'll have accumulated depreciation of $12,000, which leaves us a salvage value of $1,000. In the case of miles, we're going to determine what the mileage is. So again, the depreciable basis would be the cost less the salvage value, or $12,000. And we're going to divide 12,000 by 100,000. And then we're going to determine how many miles we actually drive that month. And we're going to multiply our per mile rate times the number of miles we drove. And that's going to give us the depreciation for the month. And this is something a cab company might do. This would also apply to machinery. And except instead of miles being the factor, the hours. You would say, hey, this machine's going to last 5 years or 150,000 hours. All right. So let's see, 100,000 divided by 12,000. So that's cents. Is that it? All right. So again, the same amount each month on straight line. The depreciable basis or cost is 12,000. You divide by 5, and that's $2,400 a year. But we're going to post depreciation monthly, so we're going to be that's $200. And you can see over time, and this would have assumed that we buy this in January. If we bought it in June, it would be different for the first year. And so really we would be depreciating half a year the first year, then 4 years, full years, and then half a year at the end. But the accumulated depreciation will be $12,000, which leaves a book value of $1,000. In this case, we're going to go, well, we're going to use the sum or the units of production method. And so we divide the cost minus the salvage value is $4,800 for depreciation. In this case, okay, so double declining balance. Let's go to the units of activity. Units of production, same thing. So it's 12 cents a mile. So if we drive 1,000 miles the first month, then we are going to depreciate it 0.12 times 1,000. So I believe that should be 20. But here you can see that in 2027 we drove 15,000 miles. Multiply that times 0.12, and that's our depreciation expense. And so accumulated depreciation is the depreciation, you add it. So because this is a balance sheet account, you continue to add it and it has value. So again, after we get to 100,000 miles, we have fully depreciated this other than the residual value here, or salvage value. The end result is the same, but the yearly and monthly depreciation are different. You can see here that declining balance is 5,200, 3,120. So again, declining balance. So it is measured on the actual book value each time. The end result is that you still only depreciate what you thought you would. And let's say that you continue to use the unit under the units of activity. You might continue to depreciate this, or at some point you might change the depreciation schedule. And if you did that, you would just need to advise your shareholders. Here's an example of how each one looks. Again, modified accelerated cost recovery system, that is only for tax purposes. And then normally you'll put a note in your financials to go, here's how we do depreciation. And you can revise it. You can say, well, this is not lasting as long, so I need to depreciate it quicker, or we're gonna keep it longer, so maybe I adjust depreciation and lower it. In this case, they Change the depreciation. So at this point, the depreciable cost is different. So the remaining years is 3 years. So the depreciation now is going to be $1,200. Now, permanent decline in a fair value of an asset means that you're going to impair it. So you're going to write down the asset value to the new value. So if you had a building and you had depreciating it, and all of a sudden every building in that city lost value. So it's not even worth what your book value is. Then you would need to write the asset down. So let's say that you had depreciated, but you had the asset after adding the accumulated depreciation and the cost together, and now it's only worth $10,000. Or let's say $150,000. That means you're going to have to write down the asset $50,000, and that's called an impairment. And that's also how we expense goodwill, which we'll talk about here probably in the next one. So purchased a piece of equipment for 36. It's estimated 6-year useful life, 6,000 salvage value. So depreciable basis is the cost less the salvage value of $30,000. We're going to do a straight line, so we're going to depreciate it 5,000 per year. At the beginning of year 3, it's estimated the new total life to be 10 years and the new salvage value to be $2,000. So the book value is 26,000, new salvage value 2,000. So our depreciable basis is 24,000. We have a remaining useful life of 8,000, so we have changed the depreciation to $3,000. Disposal of assets. So the again, we buy the equipment and then we retire it. And really, what I want you to take from this is that you need to either determine whether it's a gain or loss on disposal. And to do that, you first have to go, okay, or you have to first have to determine what is your book value. So let's say that we have a cost of 10,000, we depreciated it, accumulated depreciation of 6,000. So 10,000 plus a negative 6,000 gives us a value, a book value or net book value of 4,000. If we sell it for more than that, it's a gain. If we sell it for less than that, it's a loss. So our book value is $4,000. If we sell it for 5,000, the difference between 5,000 sales price and 4,000 book value is $1,000. On the other hand, if we sell it for 3,000, we've got an asset of 4,000 that we're sold for 3,000. So we're going to have a loss on disposal. So compare the book value. If proceeds exceed the book value, it's a gain. If they're less, it's a loss. Okay, let's just zip through here. Same thing with retirement plan assets. In some cases, there may not be a market for it, and your salvage value is 1,000, but you have to just give it up, and so you get nothing for it. So that's a loss on disposal of $1,000. You can see here the loss is equal to the asset's book value on the date of retirement. All right, so I'm going to stop here, and I'm going to create another video for the remainder of this chapter.